Hi everyone, today we talk about Fedex and Fedex being down 40% from its all-time high. Got some interesting stuff we're going to talk about Fedex today, but we'll get stuck into the fundamentals. We'll talk about Fedex and why it's down, and then I'll recommend what I think you should do with Fedex. So actually I recommend Fedex as a buy back when it dropped to about 180ish or 190ish a couple of months ago. It seemed like a pretty good bargain, but since then the whole earnings and the economy hasn't been too great, and it's suffered quite a bit and gone down from there, and like a lot of companies it's gone down quite a bit, and it's down 30% from its all-time high. It's about $159 per share as recording this video. Its PE is at 8, and that's not forward PE, that's just normal PE today. Dividends at 65 cents, and its EPS growth from 2019 to 2020 is 16.9%, and sales is 5.6%, which is some good fundamentals overall, really. Really impressed with these two. But yeah, really good company. Now, the reason overall that it's gone down is because of its earnings report. Now, it came out on its earnings report and it said that it's pretty much expecting not as good as a year. It's cut its guidance, but the majority of companies have. The earnings report wasn't too bad, but yeah, it's cut its guidance, and whenever a company cuts guidance, you see a big slope in the stock. And then it wasn't helped because we had a bit of a bad day in the stock market. It also came out that Amazon are considering doing their own delivery, which is currently, I think Amazon makes up about 3 to 4% of FedEx's revenue, which isn't too bad really. Obviously it would take a little bit of a hit, but it's not as big as people think, which you've got to be careful of. You've also got the growth of e-commerce on the Shopify websites and what have you. That's getting bigger. The parcel size still growing at about, I think it's about 3-4% or something around there, which is pretty good, and will probably continue to grow as a lot of companies and a lot of startup companies go to the online side of it. It'll still do well with that side of it. Letters are still growing a little bit. I think it's like a 0.5% clip, something around there. But it's still growing at a nice rate at the moment. 5.6 is a great rate. It's kind of one of those where it's a bit of a growth stock, and it's also got a dividend side of it. But yeah, it's down quite a bit. So overall, I'm kind of going to talk about Fedex, and normally I'd either just go buy it or sell, but it's at an interesting point because 40% is obviously a lot. Fedex has got a big history of when it's down that much of not recovering it very fast. The last time that Fedex dropped as much as this was back in 2008 in the Great Recession. Back in 2008 it actually dropped 60%, and when it dropped 60% it took from 2008 to about 2012 to actually recover all of them losses. So it took about 4 to 5 years overall to actually recover that big massive drop that it had. So that's something you've got to be careful of. It could, if you invest your money at this price, it could take a while to get back up there. But overall, if the stock market is going to go up, we do need the transport sector to go up with it. So what I'd say with Fedex is it's quite of an interesting play really, is that fundamentally it's a great company. It could be slow to recover. It's not one of those stocks I'd put as your main position, but when it's at this sort of price, it's quite an interesting price. I would say probably not to go all in on this stock right now. It's probably best to pick up a few shares, because I think Fedex does have the potential, and with the stock market in general, to go down a little bit from here, which you've got to be careful of. It could go to 60% down. If it does go to 60% down, I don't think it could go any lower than that. So what I'd say is average your position down, maybe buy a few shares at 40%. When it gets to 60, maybe add a few more in there, and I can't see too much downsides from there, because when it last went down 60%, its like EPS and its revenue was down like 40%. Now its revenue and EPS isn't going down that much, so it shouldn't drop that far, and if it does, it's definitely a good bargain price right there. But like I say, it doesn't look like its EPS and revenue is going to get affected that much, so the stock shouldn't go too much down from 159 really. Even going forward, if the Amazon side of it is lost, it will still be in a decent position. So yeah, overall fundamentally great. Don't worry about Amazon too much. Like I say, I won't go all into this stock right now. Just see what happens with that movement of the price. But I'd probably say for a diverse portfolio as well, or dividend portfolio, and even a little bit of a growth portfolio, it might be one just to consider just putting in there. with a few shares. That's the video for today, guys. Give the video a like, subscribe. I'll be doing the free stock sign buying in January next, and I'll see you on the next video.